Unit 5, Money Markets, Lecture 1, Introduction to Money Markets, Part A. We're looking now at a diagram that looks very similar to one we would have seen during the unit covering the financial system. Essentially, a market just allows funds to flow between those individuals who have surplus funds, the lenders, and those individuals who have a shortage of funds. The money market is just essentially a market where there is short-term lending. If we look at some of the main characteristics of the money market, it's a wholesale financial market for the raising of short-term funds. Essentially, these are debt securities, which means that the lenders expect you to pay them interest. They have maturities of up to 12 months, so they can be anything from a day to a year when they're issued and traded. Many securities issued are negotiable, and they are actively traded in the secondary markets. The two primary types of instruments in money markets are discount instruments and yield instruments. Yields represent the return on a loan or investment, and they're usually stated as a percentage. Yields are calculated by dividing any income that you receive on your investment or any interest you need to pay on your loan by the purchase price or the loan amount that's invested. Rates of return usually expressed as a percentage over a standardized period of time, and this tends to be a year. It provides a basis for comparison between different investments, and we'll talk about this in a little bit more detail later when we talk about effective annual yields. The size of the transactions on a money market, wholesale transactions, are a minimum of R1 million. It's an over-the-counter market, so it's an informal network of dealers and institutions and investors. There is no exchange used, so you are exposed to default risk or counterparty risk. So you're exposed to the risk that the person or the investor who is on the other side of your transaction could default on you. Contracts can take on various forms, so they are customized. They are short-term transactions. They can be from 1 day to 1 year, but they are limited to a maximum of 1 year. It includes both domestic and international markets, and you can invest either directly in cash or through money market instruments. Money market instruments are broadly defined in two categories. There are discount instruments and coupon or yield instruments. We can further break down the discount instruments into straight bank discount instruments or discount to yield instruments. And if we look at the slide, it just gives us the different types within each category. It is important to understand the difference between money market instruments that are issued by the ultimate borrowers, called primary securities, and those money market instruments that are issued by financial intermediaries, also referred to as indirect securities. And if we look at the primary securities, they include bankers' acceptances, treasury bills, and promissory notes. And the indirect securities, these issued by the financial intermediaries, include negotiable certificates of deposit, otherwise known as NCDs, and repurchase agreements or repos.